Hi, this is the story of the awesome oscillator, how it evolved from the awesome oscillator to the Ames wave into the Ames E wave. The objective of this training session, number one, is introduction to the AO. So first I'm going to introduce the AO, then I'm going to explain the AO, the awesome oscillator, and take you through the internal structure of the AO, the skeleton of it, if you like. Oh, like the doctors say, we're going to look at the anatomy of AO. Then I'm going to explain the AO and take you through the internal structure of the AO, the awesome oscillator, the skeleton of it, if you like. Oh, like the doctors say, we are going to look at the anatomy of it. The doctors or the students, the medical students, yes. In fact, that could be a great title for this video, The Anatomy of AO. So, and secondly, we're going to talk about the third objective is evolution of AO into Ames wave. I'll go into how we arrived at the Ames wave indicator. And lastly, we will explore the advanced version of Ames wave, the Ames E wave. So let's begin. The story of the humble oscillator. So this is the story of the humble oscillator, how an oscillator changed the industry, how a simple moving average crossover can become such an amazing indicator. But first, I'm going to introduce the AO. And before that, let's find out what is an oscillator, because there are different types of indicators. They can be classed as moving averages and different types, but one of them is oscillators. So what is an oscillator indicator? From Wikipedia, the free encyclopedia, an oscillator is a technical analysis indicator that varies over time within a band, above and below a zero line, or between set levels. The concept that we call the zero line, and then the concept of close to zero line, which we discussed in the video before. I'm going to link that video in the description. Oscillators are used to discover short-term overbought or oversold conditions. That's what they put it as the general explanation of it. But overbought, oversold is kind of a myth. It is a terminology that we don't need to go into, because there are really no overbought and oversold conditions, especially in Forex. And they just refer to that particular time period that you're looking at. There are several kinds of oscillators, as I mentioned before, out there, but AO is not just an oscillator. Oh no, you'll soon find out why. Keep watching. So now let's look at what is the AO. The story of the AO goes like this. AO stands for Awesome Oscillator. Why that name? Because Bill Williams introduced this indicator in their original course and called it the Awesome Oscillator because, according to Dr. Williams, this is the tomorrow's Wall Street Journal. Check out the famous setup for this. Actually, it is tomorrow's Wall Street Journal, or maybe more. First step, let's first install the MT4 standard indicator called the AO. And I'll show you what it looks like on screen, and I'll show you what it actually shows in depth. This is something I promised in my last video but forgot to add it in the end. So here it is, and I will link the video that I'm referring to in the description. So here is a chart from Bitcoin. Everyone loves Bitcoins. Before I go to the AO, let me just show you. This was that peak that happened in June this year when it went all the way to 13,000, and that was, after it dropped from its highs back in 2017, 18. It spent all the way going down, and as soon as we entered 19, it started going up. A lot of people invested money, and it went down. And this is going to be subject of one of my videos of the history of Bitcoin, because this stuff, this is not the first time it's done that. Oh yeah, not the first time. This is what made all the news, and people talk about this, but actually it has been doing that for quite a long time. We'll go into that later. Let's just go to the hourly chart. I've already added this indicator, but what I'm going to do is I'm going to delete this. So this is how you do it. You can go to Insert, Indicators, and these are the Bill Williams indicators. So you go to Awesome Oscillator. It comes up here. I leave the colors as it is. At standard, the width of the histogram bars are like this. So I put it at the third level there. Levels, I don't have a level. It just oscillates around the invisible zero line, and like this I'll click OK and it will appear at the bottom, and that's what it is. So there's a crossover of the zero line, as you can see here. This is the zero line. When price starts to drop and it's on the right side, it's below the gator, the oscillator goes below the zero line. And when there's a little bit of pullback, when the next bar on the AO is slightly lower, well, in this case, because it's down, so it's going to be higher, right? So if it is higher, which means price has gone up a bit, it would compare it to the one before, and it would color it green. This is green because the value of this is higher than the value of this. In this case, the value of the next bar is lower than the one to the left, so it's colored red, and it will continue to color it red as long as it keeps going down, and the moment it goes slightly up, it's going to color it green. And that's what this oscillator is about. And I would plug that in again. If you want to learn to trade, if you want to learn to count Elliott Wave in 10 seconds, you know where to go. Link is in the description. And from that concept, when you see a peak of AO, and then it comes back to the zero line, and then it goes back in that direction and it diverges, you see a 3, 4, 5. That is the whole concept. So we wait for 3 and a 4, and we enter here, and we get out somewhere which is called the target zone 1. So let's not go into that. So I was going to talk about the AO. So this is the AO, and let's go back to the presentation. We will go to the next, the other, and now let's go back. So Dr. Williams conducted extensive research. By the way, he is a physicist by profession, so research is embedded into his personality. So he found that this indicator can plot a perfect Elliott wave count without learning the complex way of counting the wave. As we know that this concept was originally introduced by the founder Elliott Wave, who named it after himself, the humble guy indeed. So Mr. R.N. Elliott thought the market is an intricate mesh, kind of like a Lego work of waves that fall into two main categories. The market, that is the chart, is made of impulse and corrective waves. Impulse waves, corrective waves. Impulse waves, corrective waves. The market does not move in straight line, right? So this would be an impulse wave, and the way we find out what is an impulse wave is we look at the gator. When the gator is open, green below the red, red below the blue, blue below the purple, this is open, and the AO is below zero line, we say it's an impulse wave. Within that impulse wave, when the AO starts going back to the zero line, this is a corrective wave. The market, that is the chart, is made of impulse and corrective waves, and that impulse waves have 5 waves inside them. But the corrective waves have 3 waves inside them. Stop, 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 stop. I know. It's already getting complicated, right? Forget that. Let's cut to the chase. You should know, if you've read about the Elliott wave theory, that the meat of the move is in the impulse waves, like you saw in the chart that I showed you just moments ago. And everyone wants to hit the wave 3, right? Because that makes sense. Like, wouldn't you like to hit this wave? We'd like to cash this one because there's more money in that. And if you go to the daily chart, you'll see this is the impulse wave. You want to trade this one, not this one. But because, yep, I answered it already, because wave 3 is the biggest portion of a strong trend. So logically, everyone wants to trade wave 3. What if I were to tell you that the traders who chase wave 3s almost always miss the move because they look for the wave within the sideways markets? A wave 3 is kind of like a seed that is buried under soil, but that there's a bunch of seeds spread across the field and you don't know which one will germinate first, which one will pop up tomorrow and turn into a seedling. So you start digging for seeds. Now that's not a good idea, is it? Because this could destroy the field. So you wait. Most traders waste their time and money chasing the wave 3. It's that elusive dream. It's the gold rush. Wave 3 is the gold rush. And when they find it, they don't know where will it end, where to exit, and what should be the target area. Because remember, the golden rule of trading is that you should know exactly where to exit. What we have found in the last 10 years of trading, myself and my friends, is that chasing the wave 3 is going to make you lose a lot of money. Now it looks like I'm saying the opposite, but the reality is that the more you chase these 3s, you will end up paying a lot of losing trades, small losing trades, quite a lot of them. And then to cover that cost, you will have to come up with a different strategy whenever you hit that wave 3. So there is a strategy for that. It is possible. But, however, that is not the subject of this video at the moment. So because wave 3s grow out of dirt, that is the sideways market, and that means trading breakouts of no trend zones, the clusterfuck areas, you know, the charts that look like poop. Let me show you some. So you see something like this. You're going to find the wave 3, but you have to keep entering here and there. So how do you hit the wave 3? What is the secret? How to trade wave 3s without paying a lot of, without incurring a lot of losses during this range? How to avoid those numerous losses? Surely there is a solution, right? Yes, indeed. So what is the solution? So what we have found is that the best way to trade the wave is to let the 3 happen, wait for the 4 and trade wave 5. And guess what? Even when you're trading the wave 5, you are still trading wave 3. This is a lovely concept, because when I first introduced this concept, you'd think, okay, so he's telling me not to trade wave 3. He's telling me to trade wave 5. But what I'm saying is that we have a technique, the setup 1, which will let you trade wave 5, but at the same time you would still be trading wave 3s. Because if there is a 3 and a 4, there will almost always be a 5. But if you try to trade wave 3, you have to find wave 1 and 2. And that is the hardest thing to do, especially on the lower time frames. Why make things difficult if there is a problem, if there is a simpler solution available, right? And yes, there is a simpler solution. The approach we take is trading the wave 5. There are several benefits of this. Wave 5 can be predicted with 80% success rate. The risk of taking the trade is minimal and the reward is 3 to 5 times over. Risk $1 for $5 return. Cool. Wave 5 can be measured with a degree of accuracy, and it can be predicted in advance. Wave 4 can be measured, which will allow you to prepare ahead of time. So if you can measure the 3 and 4, you'll be able to take a measurement for the 5. So every time you take a trade, you would trade it stress-free because you will know exactly the 3 possible outcomes. Uncertainty is the enemy of traders. AO takes away the uncertainty out of the trading. So what about AO? Yes, I went in on a limb there, right? I went on a tangent a bit, but there it was important to basically introduce the power of AO. So Dr. Williams found that you can spot and count the waves simply by looking at the peaks and bottoms created by this indicator, like I explained a little bit earlier. Check out this video I posted earlier about Ames wave. It's in the description. A little bit of background of the AO. So Ames wave is derived from Bill Williams' indicator called the AO, available in MT4 as standard, as you saw. Ames wave is an advanced version of that indicator. It shows 4 colors. And the reason we evolved from AO into Ames wave is that there was something missing on the AO. The AO was showing the peaks on either sides of the 0 line, but it wasn't showing the increasing momentum and decreasing momentum. And Ames wave has 2 further advanced versions. Of the 2 further advanced versions, I'm going to talk about the next level one, which is my favorite, the Ames E wave, or the Snome's E wave. So what does the Ames wave do? It helps the trader understand the momentum of the market. It helps the trader reveal the hidden structure of the market. How is Ames wave calculated? Ames wave is a 34-period simple moving average plotted through the middle points of the bars, which is subtracted from the 5-period simple moving average built across the central point of the bars, the high plus low divided by 2. And now let me show you through the chart how it's done. So we're going to do a little exercise. We know that the AO is made of 2 simple moving averages. So what I'm going to do is I'm going to enter the 34 simple moving average. I'm going to color it yellow. It's simple and median price, high, low divided by 2. And I'll show you what it means. So if I change this to candles and zoom in a bit, see, this is a candle. This is the high of the candle and this is the low of the candle. So when the moving average is calculated, what it would do is it would take the value of the high, right, and the value of the low and divide it by 2 to take the average. So this is the 34 moving average. And now add one more moving average. And let's color it something that stands out. So this is the 5 moving average. So as you can see now, let's change it to red. Yes. So we now see that I'm actually going to make the chart disappear so we only focus on the moving averages, and that can be done by going to properties and you change the color of the line graph to none and then you select none. So if you clicked on the candles appear, the bars appear like this, and if you click on the line graph and then change that, then you don't see it. So here we go now. This is what we have. Now what we see is we're not seeing the price, but we're seeing the 2 moving averages of the price. The red is the 5 moving average and the yellow is the 34 moving average. As price moves starts to move, the faster moving average goes away from the slower moving average. And as price starts to come back, as you can see here, the faster moving average starts to come back as well. It catches the wave function of the market pretty nicely. This is a current chart, by the way, right now, what's happening. Did you know about this little trick? So why am I showing this? I'm showing you this because what the AO is showing is that every time the 5 moving average crosses the 34 moving average, there will be a cross of zero line on the AO. Now let's add the AO. Before that, let's look at it. Can you see this is like stacked as oscillators? There are all different types of oscillators. The most famous ones are the MACD, the stochastics, the RSI, the average true range, but I don't like it to be plotted like that. I rather have a number. And the moving average oscillator. So really, AO is a moving average oscillator, but it's classed, it's got its own category. It's the awesome oscillator. Now, every time the price crosses the zero line, that actually indicates that the 5 moving average has crossed the 34 moving average. So is this oscillator really just the moving averages? That's not it. On the face of it, it is that. But underneath it, it actually shows the momentum of the market. So we know that the market is going down here. But we want to know, how do you know if the momentum down is increasing or is it decreasing? So when the 5 is below the 34, the AO will be below the zero line. And now this is the bit that I wanted to explain. This whole exercise was for this. These histograms actually show the distance between the 5 moving average in that same time period. This distance from this area to this area is plotted as histogram. So what is the purpose of that? What it does is that when you look at the market, you can sometimes not see correctly whether the momentum is going down or is it decreasing or not. But these histograms start to show you that when the market went down first and when it pulled back, it did not go down as much as it should have, not with the same momentum. And when the momentum is lower than the momentum before, then it causes a divergence. This concept is in line with the Elliott wave of 345. So whenever there's a first impulse wave and then there's a correction, if the second impulse wave has lower momentum than the first one, then that would be a 345 situation. So if you look at the price like this, you don't really see that divergence clearly. The expert price action guy would be able to see it, but not on the first glance. You have to measure it. Here on the picture, you clearly see this is happening. But the problem is, with the two colors of the awesome oscillator, we start to see green, whereas the price is still below the 34. So the trend is down and the momentum is changing. It's telling us to go long. See, it's telling us it's green, go long, but that's not the time to go long. It's a corrective wave. Around here, price is going up and it starts to tell us to go short, to sell the trade, to sell, to take a sell order. But that's not right because the trend is still going up. So we thought we need to find a solution. And the solution is the Ames wave. And the Ames wave has two main benefits. It shows momentum of the market, not just on which side of the oscillator but it also shows that the momentum is up and increasing, or whether it's up but decreasing. And that it would do it like so. Let's go to the same chart and apply the template. I prepared this earlier. So if you look at that same chart now, this is that same chart that we looked at earlier. Here it's showing the momentum is down, and now it's showing momentum is up, but momentum surely is not up. So we added extra coding to it. So now we see that the momentum is down. Here, the momentum is down but decreasing. And this we learned is a great indicator of corrective waves. So when you have a peak of AO, or a peak of wave, and then it starts to come back to the zero line, those are usually corrective waves. And then, as you can see here, these little green dots, you can't see them on the AO. It still shows momentum is up. But with the Ames wave, it creates this special 3-4-5, what we call the 3-4-5 pattern, because it comes, it goes red, turns maroon, and then it creates those 1 or 2 green dots. That these 2 dots are very important for us, because with this, there's always timing of Gator. Gator sleeps, and we have the red dot, and then we enter at the break of the tight box. And this is what creates the setup 1. And then, as we applied the logic of the 10-second Elliott wave, we wondered, what if we could have that coded? What if the indicator tells us that this is 3 and this is 5 by measuring the peaks? And if you read that ebook, link is down in the description. If you look at the chart and measure the last 140 bars of AO, and you look at the tallest peak of AO, I know it's down, but we still call this the tallest. So if you look at it, this is the tallest peak in this occasion. And if you look at this one, if you go to last 140 candles, this is the tallest peak. And because this is the tallest peak, this would be considered as the wave 3. And when it goes back down, so for example, when we were here, suppose the market was at this point. And we looked at the candles starting from here back to 140. We measured, this had the lowest point. This was the biggest peak. So this would be classed as wave 3. And then we say, okay, after you have identified the tallest or the biggest peak, you wait for it to come back to the zero line, and you need to have at least one dot that is the opposite color of this. So if it's red, we need a green dot. And it turned green. Now we want to enter the trade in the direction of the previous peak being down. So we want to trade here below the box. And if the next wave diverges, that means that price goes below the previous. So this is the peak of price that created this peak. But if the next wave actually goes below the peak of 3, which we suppose is a 3, but the momentum of it on AO or Ames wave creates a divergence between the 2 peaks, then this would be considered as wave 5. This is the simplest way of counting wave. What if we coded that and we didn't have to do it visually? We just look at it and we have it. And the answer was Steve's coding, and he did it. So now, if you look at this chart, the tallest peak in the last 140 candles above the zero line, and now notice this, it's going to be 2 counts. One will be above the zero line for the upward momentum, and the other count will be below the zero line. So when the code is looking at the market, the tallest peak in the last 140 bars, which is this one, is this one. This is the tallest, or let's just talk about the bull because that's clearer now. So if you look at these 140 candles, the last 140 bars above the zero line, this is the tallest peak. So it suggested that this most probably is, and mark the words, most probably is the wave 3, because Elliott wave is a potentiality. The previous wave is confirmed by the existence of the current wave. So it says that this could be a 3, but it will be confirmed when the wave 4 is confirmed. And for the wave 4 to be confirmed, the minimum requirement of it is for the AO to turn red below the zero line, which it did. But the Ames rules, and these are not in the original rules of counting AO, this is what we learned in the last 10 years, is that when price goes below the purple, we are not interested in calling this a wave 4 anymore. We start looking for a new situation. So in this occasion, we have a new 3 being created, so we probably wait for it to turn into a wave 4 and trade it likewise. And this is the story of AO turning into Ames wave, and then Ames wave turning into Ames E wave. And the E wave plots those numbers, the Elliott wave numbers, for you automatically. Let me show you a few more charts where they are clearly visible, these waves. So if you look at this chart, this is a messy chart. So if you look at the chart, it's very messy. But if you look at the wave formation, it shows you a 3, a 4, and a 5. And it's 3, 4, 5. So if you look at this chart, you can see clearly. Let me delete this target zone 1. So this is a really lovely 3, 4, 5. As we can see on the price, it went down and it created the lowest peak. So that's your wave 3. And after the wave 3, when it crossed the zero line, it became the wave 4. So this is wave 4. And then this comes down, quite strongly down, but the momentum indicates that it diverged compared to this move. And the divergence actually means that if this move is 188, this move is 284. So on chart, it looks like it was kind of the same kind of drop, but actually lost momentum, and that means that this would be wave 5. Why is that? Because the rules of Elliott wave is that 3 is always the biggest, and wave 5 is the second biggest, but it's usually always less than wave 3. And then there's another technique of actually counting. So the Ames setup is based on the target zone 1. We know that when you have a 3 and when you have a 4 that actually bounces against the purple, guess what? It's going to come and hit target zone 1, which is the fib expansion 62. So that actually means that if this wave 3 was 100 points and the wave 4 was 50 points max, it could be 38 points, wherever it ends from there, it would actually go 60% of the wave 3. So if wave 3 was 100 points, then wave 5 is probably going to be 60 points, and you will count that 60 points from where wave 4 probably ends. So in this occasion, if this is wave 4, then this is where it ended. This will be plot, and that is target zone 1. And just look at it. I just randomly selected this chart. I just looked at it, and you can see that if you entered the trade, this is the apple signal, by the way, Ames the fruit. So this is the apple signal. When a fruit is between the gator and the purple, it's an apple signal. We would have gone short here with stop loss up there, and our target would be just above the target zone 1, and you don't need to do anything after that. Just walk away, and the script will look after it, and it would have hit the target point. At the risk of 55, you made double of that on this occasion. Now there are, at advanced level, you have ways to actually further enhance your profitability by scaling in, but that is beyond the scope of this video. This video is too long already. I hope you learn something, and I hope you apply these techniques, and these techniques can make you a lot of money. If you would like further guidance and want to learn it properly and want to use our indicators, please go to itradeaims.net and consider becoming a member. So thank you.
Thank you for watching. I hope you liked this video, and if yes, please hit the like button. Do you have any questions or ideas for upcoming videos? Then leave a comment. Also subscribe to the channel and hit the bell icon so that you never miss any future videos.